Hi, I'm Ruban Selvanayagam from Property Solvers. You may be aware that according to the latest UK house price index published by the ONS using HM Land Registry data, London is now the only UK region showing an annual fall in house prices. The question is whether that signals a crash or something very different, because when you dig into the data and see what's happening on the ground, it's clear that what London is experiencing is much more nuanced than a sudden collapse. It's a slow, uneven adjustment shaped by stretched affordability, high costs, seller expectations, and a housing system that isn't delivering enough supply. In this video, I'll focus on what that actually means if you're thinking about buying or selling in London, what areas are under real pressure, and why confidence and liquidity now matter just as much as price. Let's dive in. The first thing to understand is where those falls are actually happening, because the weakness isn't spread evenly across London. It's actually quite concentrated. Drawing on the same ONS and Land Registry data, inner London has been hit the hardest. In November of last year, prices there fell at the fastest pace since the global financial crisis, down 4.6% year on year, following a 4.3% fall in October. The steepest declines are in the most expensive boroughs. In Westminster, average prices fell by 15.5% to around £866,000. In Kensington and Chelsea, prices dropped by 16.3%, taking average values to roughly £1.19 million. These aren't marginal corrections, they reflect a clear pullback in demand at the very top of the market, driven by affordability pressures, changes to non-dom tax status, and growing uncertainty around the future tax treatment of high-value property, including renewed discussion around so-called mansion taxes. But crucially, this isn't happening everywhere. Using the same official data, many outer London boroughs are still showing price growth. Bromley, for example, has recorded annual increases of around 5 to 6%, with areas such as Bexley and Sutton typically witnessing growth closer to 3 to 5%. That contrast tells us that this isn't a citywide collapse, but an uneven adjustment, with the pressure concentrated where prices were already most stretched relative to incomes. Taken together, those sharper falls in inner London are still enough to pull the Greater London average into negative territory, with prices across the capital down by around 1 to 2% year on year, taking a typical London home to roughly the mid 550,000s. By comparison, UK-wide prices rose by about 2.5%, with regions such as the North East seeing growth closer to 7%. London stands apart, and one of the key reasons is that affordability has clearly hit its limits. Interest rates may have eased slightly from their peak, but they've reset to a much higher level than what we were used to in the 2010s. In a city where prices are already high, even small rate changes now have a disproportionate effect. At the same time, wages in London haven't kept pace. In real terms, many households are earning no more than what they were years ago, which limits how much pressure they can absorb once they step into ownership. That's why prices can be flat or even falling in real terms and still feel unaffordable. The problem isn't simply that prices are too high. What's emerged instead is a deeper structural mismatch between what people earn and the real cost of owning and delivering housing in London. And that's why the issue is so often misdiagnosed. It's usually framed as a planning problem or a demand problem. Increasingly, it's neither. At its core, it's a cost problem in a city that's become one of the most expensive places in the world to build, whilst house prices and ownership costs remain far ahead of wage growth. That gap matters because construction costs have surged over the past few years. Labour, material, regulation, energy, and everything in between. And as those costs rise, fewer schemes stack up financially. The consequence is a clear feedback loop. Fewer schemes start, supply stalls, and fewer homes come forward. When that happens, affordability in London never gets the chance to reset. This isn't a boom-bust cycle, it's stagnation by design. You see it clearly in London's delivery data. According to figures from the Greater London Authority, or GLA, construction started on just over 5,000 homes across the whole capital last year, the lowest level in more than a decade. That collapse isn't because sites don't exist. Planning pipeline analysis by Lichfields, backed by Glenigan construction data, shows well over 100,000 homes in London already have planning consent, but haven't started on site. These homes exist on paper, but not on the ground, because current build and finance costs have overtaken achievable values. But developers aren't panicking, they're pausing or adjusting their strategy. In many cases, that's because larger house builders and institutional-backed platforms still have enough balance sheet flexibility to wait, rather than force schemes through at a loss. Research from Savills and Knight Frank shows that many London schemes are being delayed or resequenced rather than abandoned, as developers wait for build costs, finance costs, and land values to realign. What's telling is where delivery is actually happening. During 2024 and 2025, a number of London developments that had been marketed, designed, or underwritten on a private sale basis were instead sold into or retained for build-to-rent ownership. Examples include bulk acquisition and strategy shifts at schemes in Goodmayes, Wandsworth, Clapham, Streatham, and Docklands, involving groups such as Principal Asset Management, Around Town, and Chalgrove. In each case, the common thread wasn't a collapse in demand, it was a change in underwriting, away from peak for sale values and towards long-term income-backed returns. Where land has been bought at more realistic prices and capital is genuinely long-term, schemes can still move forward. Returns are then underwritten on rental income rather than sales prices. And that contrast reinforces the real constraint in London's housing market. Not a lack of demand, but land values that haven't yet adjusted to today's cost base. The situation is even more fragile when you look at affordable housing. Recent research by Molior suggests that construction has been overstated by around 100%. Their work is based on site visits and interviews, not planning assumptions, and it paints a much starker picture of what's actually being built. Molior estimates around 22,500 affordable homes are currently under construction in London. Official figures from the GLA suggest closer to 45,000. But the real issue isn't today's number, it's what happens next. Much of that affordable housing pipeline completes during 2026. After that, new starts drop off sharply. By early 2027, fewer than 10,000 affordable homes may be under construction in London. That's not a slowdown, it's a cliff edge. And this is happening at the same time as private delivery is also weakening. Against that backdrop, the shift in tone from the government is telling. In January 2026, the latest Housing Minister, Matthew Panicking, openly acknowledged that London's land prices need a market adjustment. He described a system that locks in an upward ratchet of land and house prices, limiting volume. And he admitted that the private market, as currently structured, won't deliver enough homes on its own. I'd argue that what matters currently in London's housing market isn't where prices sit on a chart, it's confidence and liquidity. Housing markets don't seize up when everyone suddenly agrees prices should be lower. They seize up when buyers and sellers stop trusting the signals around them. And that's exactly what's happening in many parts of the city right now. Starting with buyers, most aren't stepping back because they expect prices to collapse. They're stepping back because the forward view is unclear, particularly on borrowing costs, stamp duty obligations, rising conveyancing fees, and regulation. In a market as expensive as London, even small uncertainties can get magnified quite easily. Historically, London buyers have been comfortable acting with only modest expected growth. Low single-digit price rises are often enough to create confidence that today's price won't feel like a mistake later. When prices are flat or drifting, that conviction fades, even if the headline values don't move much. That said, the market hasn't frozen completely. Some buyers still move regardless of sentiment, families buying around school catchments, downsizers releasing equity, people relocating for work, or those whose housing needs simply can't be deferred indefinitely. What has changed is how risk is being looked at. During the years of cheap money, a lot of the risk in London housing was simply assumed away. But now transactions have become much more price sensitive. They still happen, and in many cases, they're the deals that actually clear in this kind of market. The key shift is that discretionary buyers wait, whilst needs-driven buyers negotiate. It's a subtle change, but one that has meaningful impact on liquidity and pricing behaviour. Data from property portals such as Rightmove and Zoopla and analytics firms show that the market isn't collapsing so much as pausing. In 2025, the average time to sell a property in London increased compared to 2024, and a noticeable share of homes being relisted had first been taken off the market and then reintroduced after a break. Behaviour consistent with sellers taking the step back when expectations aren't being met, rather than being forced to sell at reduced prices. We see the same pattern in our own data at Property Solvers. Our asking price versus sold price tracker shows the gap widening across much of London, not because buyers have disappeared, but because it's taken longer for the market to agree on value. We've included a link into that tracker in the show notes if you want to take a look at how this gap looks in your own area. In markets like this, it's often the adjustment of expectations, not a sudden fall in values, that ultimately brings transactions back to life. That creates a standoff, not a crisis, but a pause, where transactions slow long before prices meaningfully adjust. So fewer transactions means weaker price signals, wider bid-ask spreads, and longer decision cycles. That's when the frustration sets in. For sellers, it can feel as though demand has vanished, when in reality both sides are reacting rationally to uncertainty, just from opposite ends of the table. A fair proportion of London properties still sell quickly, at or close to the asking price, particularly where pricing is realistic and the asset is straightforward. Well-located 2- and 3-bedroom houses with garden space are a good example of this. They continue to attract strong interest because they meet real practical demand. By contrast, other properties sit for months, even after reductions, because expectations haven't caught up with how risk is being priced. It's also worth recognising how past policy choices continue to shape today's market. Schemes such as Help to Buy supported demand for new build homes for many years, but they also pulled forward demand and arguably inflated prices in parts of London. As that support has been withdrawn, the market is adjusting without the same artificial boost to buyer confidence. At the same time, a significant number of flat owners face constraints that have nothing to do with price at all. Ongoing cladding and building safety issues mean tens of thousands of apartments in the capital remain difficult to sell or remortgage. Even where remediation is planned or underway, uncertainty around costs, timeline, and lender requirements continues to suppress liquidity. The result is a market where some sellers choose to wait, others are effectively stuck, and buyers become increasingly selective. That combination slows turnover, clouds price discovery, and reinforces the sense of inertia, even in the absence of widespread distress. From our perspective at Property Solvers, this kind of market isn't unfamiliar. We've operated through multiple cycles in London, and one pattern repeats whenever sentiment softens without tipping into distress. Risk gets priced more carefully. These days, lenders, investors, and buyers scrutinise downside more closely than they did during the years of cheap money. That doesn't mean that deals stop happening, it's just that fewer marginal deals get done. Properties that are straightforward to finance, easy to understand, and resilient to higher running costs tend to retain liquidity. Assets that rely on best case assumptions, whether on price growth, borrowing terms, or future regulation, face a much narrower buyer pool. That's especially true in London, where licensing requirements, compliance obligations, energy standards, and upcoming changes under the Renters' Rights Act all feed directly into how buyers assess risk. The real-world cost of owning and running property in the capital now plays a much bigger role in pricing, timing, and buyer confidence than it did in the years of easy money. That perspective matters because regulation doesn't just influence prices, it shapes behaviour. It affects whether landlords invest further, hold steady, restructure portfolios, or decide it's time to sell. What we're seeing isn't panic, but a more cautious and selective approach to ownership as rules tighten and running costs rise. From a seller's point of view, that selectivity really matters. In markets like this, time itself becomes a cost. Each additional month on the market sends a signal, narrows the audience, and often leads to large concessions later. That's why certainty starts to matter more than theoretical peak value. We see this clearly in practice. Sellers who prioritise realism around pricing and timing tend to find serious buyers. Those who hold out for a dramatic rebound often find that the market simply moves around them. And this isn't a credit freeze. Banks remain well capitalised and willing to lend on the right properties at the right prices with sensible assumptions. Finance hasn't disappeared, it's become more selective. And that selectivity changes the question London sellers need to ask. It's no longer what could this be worth in the best case. It's what will actually transact cleanly and reliably in today's conditions. That shift isn't a sign of weakness, it's a sign of a market maturing under pressure. Understanding that rather than chasing dramatic predictions is what really matters now. So when people ask whether London is heading for a house price crash, the honest answer is that the data doesn't point to a sudden or widespread drop in prices, absent a genuine black swan event. What it points to is a slower, uneven adjustment shaped by affordability limits, cost pressures, regulation and behaviour. London hasn't crashed, but it has changed, and navigating that change requires realism, flexibility, and an understanding of how the market is actually behaving, not how the headlines describe it. If you found this breakdown useful, please give the video a like and subscribe to this channel. We'll keep sharing clear, experience-led insight onto auctions, fast sale, and the UK housing market in general. A big thanks for watching.